Hello investors and future investors, welcome to the channel. For today's video, I'm going to show you how to always keep winning based on using your chance of profitability. Now, the chance of profitability is one of the bestest things that can be used if you're selling options. Now, if you're just getting into options or you're trying to add options into your portfolio in order to get some extra money to supplement your 95, then you're on the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's option strategies, I'm going to show you how I use a chance of profitability to always keep winning and grow my portfolio on a consistent basis. We're going to be going over a few different option strategies in order to show you the different scenarios where a chance of profitability can be used in order to keep you profitable. So a bit of advanced knowledge is going to be needed come to the end of this video. Our first two strategies are going to be very simple. So if you're new to options, try your best to follow through. I will keep it as simple as I possibly can. Now let's go ahead and get down and dirty with options. For today's option examples, we're going to be using none other than Micron Technology, ticker MU. So let's go ahead right away and we're going to open up the options chain by clicking Trade MU Options to the bottom. Now, if you're new to options, this right here is what's known as the option chain. What the option chain does, it gives us a bit of information in order for us to make an informed decision of what strategies we want to use, what strike prices we want to use, the amount of premium we want to use, and even the expiration date we want to use. So the option chain is very informative. Now for the first strategy, we're going to go ahead to sell and we're going to go ahead to put. And now I'm going to be working with the expiration date. We're going to be using January 31st. So this option strategy is what's known as a cash secured put. Now with the cash secured put, I'm going to show you how I choose my chance of profitability that always makes me keep winning with this option strategy. Now, in order for us to get started, we're going to go ahead and we're going to choose a strike price below the current share price. Now I will be going with the 102 strike price. Right here, 102 to the top, you could see strike price. And most importantly, the chance of profitability. The chance of profitability I will be going with is a 73.84% or round it off to 74%. Now with the chance of profitability, if you are using Robinhood, you could simply click into this little pencil icon right here and you can adjust this if you can't right away see your chance of profitability. Or if you want to use a different one, you could change it to any one of these, break even, implied volatility, choose. But for this video, we focus in on chance of profitability. So the chance of profitability is going to be about a 74% chance. And for that, I'm going to be receiving $1.52, which is going to work out to $152. But we're not focusing on the income right now. We're focusing on the chance of profitability. Now, the reason why I went with a 74% chance of profitability is because of the nature of the option strategy. This is a cash secured put. Which a cash secured put, you're of the mindset that this stock is going to be going up. The cash secured put is a bullish option strategy. However, the reason why you do a cash secured put is that you do not mind, firstly, owning the stock in your portfolio. So since you don't mind owning the stock in your portfolio, you decide to do a cash secured put at a price of 102. So essentially what you're saying is that if the share price right here does go to 102, you do not mind owning 100 shares of this stock in your portfolio. So your chance of profitability is, let's say, very small. In my book, I call this very small, and you're going to be able to see this when we get to the other option strategies. So the chance of profitability of this being very small, which is 75%, increases your chances of you being assigned because it's only 75%. Now we're going to go ahead and we're going to focus on the second option strategy. So right before we get into the second option strategy, if you guys are getting value so far, go ahead, like the video, subscribe to the channel, and make sure you hit the notification bell. You're going to get an alert whenever I post a video so you can stay abreast of what's happening here. I do post quite regularly. Now let's go ahead and choose the other option strategy. Now we're going to go with sell and we're going to go with call. Now this is a different option strategy and this is the well-known covered call option strategy, as you will see in just a bit. But firstly, let's go ahead and choose our strike price. Once again, we're going to be choosing the strike price using the chance of profitability. Now, when doing the covered call option strategy, I like a chance of profitability of around 80% or higher. So with the 80% chance of profitability, I'm going to get a strike price of 112, and then I'm going to receive a premium of $1.28. Now, $1.28, once again, is going to be $128. If you're new to this channel, all our option strategies on this channel is geared towards growing a small account, and it's also geared towards making consistent premium in order for you to grow your account. This is why every option that we perform, we receive some kind of money. Now, back to the chance of profitability. The chance of profitability here is 80%. And the reason why I did 80% is because, let's say you bought 100 shares of this stock at $105.75. In order for you to do this option strategy, you must first own or control 100 shares of the stock. So once again, we bought 100 shares at $105.75, so it's about $10,500 for 100 shares. So now I'm going to choose a strike price of 112 at an 80% chance, meaning I give myself an 80% chance of winning this trade, meaning come expiration date of January 31st, there's an 80% chance this share price does not hit this strike price. And once that happens, then I get to do this trade again. So as opposed to the previous example I showed you, the 74% chance is very small because I do not mind getting a sign. Once I do get a sign, I will now own 100 shares of the stock. With this option strategy right now, the covered call option strategy, I'm trying not to get a sign, hence I choose a much higher chance of profitability. And if I do get a sign, this is one option strategy that's going to be a win-win option strategy. And I do have a video about how this is a win-win option strategy, so I'm not going to get into very much detail. Now, we're going to go ahead and get into one of my bestest, most favorite option strategy there is, and I'm going to show you how I use the chance of profitability to always keep winning. So, we're going to go now, and we're going to go to buy, and we're going to go to call, and we're going to select a strike date. The strike date we're going to be using for this is going to be January 16, 2026. And now we're going to go ahead and choose a strike price. As you can see, there's no chance of profitability on this right now. We're going to get into that in just a second. So now I'm going to be buying a call. So I'm going to be choosing a $90 strike price right here, and I'm going to be paying $29.55, or let's round it off to $3,000 in order to acquire this option contract. Now, this option contract is known as a long call or a leaps option contract. What this does is, as opposed to the previous example we used, where I showed you could buy 100 shares of the stock, this option contract allows you to control 100 shares of the stock. Now, instead of buying 100 shares of the stock for about $10,500, now you're able to still control 100 shares for way less. I'm pretty sure you're starting to see why this is one of my most favorite option strategies there is. Now that we control 100 shares of the stock, we're going to go ahead and we're going to do the exact same strategy that we did prior to this, which is going to be the covered call option strategy. We're going to be using the exact same date of January 31st, and now we're going to be choosing our chance of profitability. Now, the chance of profitability I will be going on this one is going to be a 93% chance of profitability. Yes, I know that's extremely high, but wait for it. I'm going to explain to you why the chance of profitability is this high. Now, with the chance of profitability being this high, 93%, my strike price is now going to be 120. And once again, we're going to be receiving some kind of money. This time it's going to be 31 cents or $31. So the reason why I chose a chance of profitability at a 93 percentile is because I own a leaps option. So with the leaps option, the whole point of acquiring a leaps option is that you're of the mindset that this stock is going to keep increasing in value. If the stock is going to be increasing in value, your leaps value is going to be going up exponentially. If you have a leaps option that's be going up exponentially, why would you want to choose a lower chance of profitability, which is going to reduce the chance of you winning the trade? Hence, I took a very high chance of profitability. Now, with a high chance of profitability, there's still a chance that a trade could go against you, but I'm going to show you how to counteract that. So with the $120 strike price, even if my chance of profitability is broken and come expiration date of January 31st, I get assigned, well, I'm going to lose my leaps. Now remember, the whole point of me choosing a very high chance of profitability is because I wanted to keep my leaps. but now the trade has gone against me and now I'm going to lose my leaps option. But here's the good news. Because I chose such a high chance of profitability, and now I have to lose my leaps option, I'm going to be benefiting in a couple ways. The first way I benefited is because I received a premium. The premium I received was $31. Now, because I chose a very high chance of profitability, my premium was very low. I could have very well gone down and choose 117 chance of profitability and receive around $33, which is a bit more, not much, but a bit more. Now, because I'm going to be losing my leaps option, that means my leaps has increased in value. And how do you know it has increased in value? Because when I got the leaps option, the share price was around 105. Now I'm going to lose my leaps option. The share price is 120 and above. So I will be making money by losing my leaps. The money I will be making is going to be $120 minus $106, which is going to be around $14. Now we're going to multiply the $14 by 100 because each option contract is multiplied by 100 shares, and now we're going to get around $1,400 in stock appreciation. So that is why I chose a very high chance of profitability. So even if the trade were to go against me, I will still be on the winning side. Now, I did explain this to you in a simple form as I possibly can, but it doesn't work out like this exactly. The amount of money you're going to make is not going to be exactly $1,400. You also have to multiply that by your delta. The delta is another thing we use in order to choose our expiration date, our expiration prices, and the amount of premium that we want to receive. But that's going to be for another video. So the whole point of this video is to show you that your chance of profitability needs to be adjusted depending on your own risk tolerance, depending on the strategy that you decided to use, and also depending on the amount of premium you mind receiving based on your risk level. So whenever I'm trading, one of the factors that has continued to make me grow my portfolio consistently is utilizing the chance of profitability. Hopefully this video has made you learn and want to utilize the chance of profitability as well. Now, thank you for watching, and go ahead, like the video, subscribe to the channel, and most importantly, if there's anyone out there that's trying to grow a small portfolio, feel free to share the video with them. On this channel, we focus on growing small accounts by using option strategies that are geared towards getting an income. Now, until the next video, keep pushing your investments.